Let's ask them. Let's bring in Barry Knapp. He's Director of Research at Ironsides Macroeconomics, along with Adam Posen, who is President of the Peterson Institute for International Economics. And I don't mean to set this up like a boxing match, but you are two intellectual heavyweights. And I hear from people all the time who they'll hear from Barry, and then they go, I agree with him, and now I agree with him. So let's just settle this once and for all. Barry, why do you think, and to what extent do you think that we should cut rates at this point?
Because I think, in essence, I think that we should cut 50 basis points. The policy rate should be set at 3. I believe that the policy rate setting is about 50 basis points too restrictive, but the balance sheet's providing 50 to 75 basis points of accommodation. So if I had my druthers, and Governor Moran detailed this in his recent paper that he constructed with some Fed staffers, as well as the speech that he gave a couple of weeks ago in Miami, you have to make the transition slowly. But by getting that policy rate down to 3, you'll do a number of things. First of all, you will boost small bank, regional bank return on equity above where it needs to be to completely reopen the small bank credit channel. That, if we use the 3-month bill to 10-year Treasury as a proxy for rough bank profitability, that spread is averaged 100, or median is 140 basis points since 1940. It's currently 60. That's why their ROE is 3% lower than the big banks, who are more fee-based and not as spread sensitive. If we were to steepen that yield curve out, that will open the credit channel for small real estate developers. You know, last time I was on, I was debating this with Steve Leisman. I think we need that credit to flow to those small developers, to small businesses.
In this view, the long end, the 10-year yield might go up if the Fed starts releasing.
Correct.
Yeah.
The problem is less on the demand side for housing than it is on the supply side. So, sure, could it push the mortgage rate up, all things equal? Yes, absolutely it could. Though if you do, you conduct this process over time, the way I view the broader plan here that Treasury Secretary Bessent would detail, Moran would certainly agree with, it seems Waller, Bowman all agree with, and Warsh likely as well. You steepen out the yield curve, you lower that policy rate, you start mitigating the problems on the bottom side of the K-shaped economy for small banks, small businesses, small business employment is decidedly weak. It's running negative 40 basis points, whereas large businesses is more like plus 80 basis points or so. That's annualized growth. So you start resolving that problem. You go through with Bowman's bank regulatory relief plan. She spelled out things like lowering the capital requirements for small bank C&I lending and small bank business lending last week in a speech. And then, in time, second half of the year, you start unwinding that balance sheet. Now, you obviously need to change liquidity requirements and all to do that, but you start shrinking both the liabilities and assets of the Fed's balance sheet. And so now policy is a little bit more balanced between big banks, small small businesses, large businesses, and that would get us to a better, more fair, lest I use that word.
A loaded word, but sure.
Set of policies. So I'm not saying that overall policy is too tight. I'm saying the rate policy is too tight. The balance sheet policy is too loose.
All right. So, Adam, do you have any issue with that, or would you say that's
okay, go ahead.
I
got several issues with that. First one is monetary policy shouldn't be used to bail out particular sectors like small banks or small business. Part of what Secretary Bessent and Chair nominee Warsh have complained about the last few years was when they tried to use monetary policy for distributive purposes, and they're right on that. Shouldn't be doing it in this direction either. Second, it's not going to work. I agree with your guest that worrying about where the policy specifically transmits is important, but if you're jerking up the long end of the curve and steepening the yield curve, maybe you improve profitability for banks, but you make credit conditions harder across the whole economy for everybody else. And if he says, on balance, monetary conditions are about right, I don't think they are, but anyway, you certainly don't want to tighten. But third, and most importantly, if you go into the actual data, the reason that small businesses and small business lending are so bad is because the Trump administration has created enormous uncertainty, not just through its trade policies, not just through its undeclared war policies, but through its investment policies, its regulatory policies, some of which are good but have been left too arbitrary, even if they're in the right direction of deregulation, and its anti-migration policies. And you can look at the data and look at the individual companies and industries, and the lowest employment growth was in those areas that most reliant on migrant workers. So, if you look at investment, there's been no investment outside of AI, as you and I have discussed previously, Kelly. That's because there is this pall of uncertainty over the economy. Meanwhile, my point, one last point, my point of view is that as the labor market shows, the economy is actually still much more resilient. And so we're going to have inflation from all of this, and it's going to get worse if the Fed continues to loosen.
So you think we're going to get inflation from all of this? And so what would your policy, if you were Fed chair for the rest of the year, Adam, what would your policy response look like?
Well, realistically, you cannot raise rates close to the election. But I think what should be happening is there should be a hike in the last meeting before Chair Warsh takes over. I think you could get a majority of the committee for that. At a minimum, you should get a clear lean in statements for a tightening direction. And I think realistically, in terms of forecast, they're going to be hiking at the December and January meetings because they're going to do nothing between now and